Welcome in this video, ZBCN coin, when is the next attack? We will analyze it. Don't forget to subscribe, like, and please watch to the end to understand. A careful look at the chart analysis clearly shows that the current structure of the price forms an extremely characteristic technical pattern, the pennant pattern. This type of structure is usually characterized by the fact that after a strong and rapid price movement, the market consolidates for a while and then resumes its previous directional movement. What is currently being observed fits exactly into this theoretical pattern. That is to say, the price first made an upward jump with significant momentum and then entered a short-term pause after this strong move. During this pause, the price fluctuates up and down, moving in a compressed structure which creates a classic pennant pattern. The pennant pattern is considered a continuation pattern in technical analysis and usually occurs in the middle of major trends. It starts with a sudden and strong price movement, followed by a consolidation that often resembles a narrowing triangle or parallel channel. This consolidation process indicates that market participants are digesting the previous sharp move and the price is temporarily directionless. However, this structure is usually broken in the direction of the trend, and the price resumes the previous impulsive move. Looking at the current structure, the price is approaching the upper limit of this filamentary structure. Although this upper line may act as resistance on a short-term basis, the nature of the pennant patterns means that a break of this resistance could be a bullish technical signal. If the price breaks this squeeze structure with upward volume, this is technically interpreted as a pattern breakout, and the price is expected to cover a distance upwards equal to the height of the pennant pole. An increase in trading volume, especially at the breakout of such patterns, is one of the most important signals confirming the validity of the pattern. If there is a noticeable increase in volume as the price breaks the upper band, this indicates that buyers are actively re-entering the market and significantly increases the likelihood of a continuation of the upward movement. On the contrary, a breakout without volume can often be misleading and result in a deceptive signal, the so-called fake breakout. Therefore, it is necessary to pay attention not only to the chart structure, but also to the volume dynamics. In technical analysis, when estimating the target price after an upside breakout of a pennant pattern, the length of the direct part of the pattern, that is the first aggressive price rise, is measured, and this distance is added upwards from the breakout point. The level obtained by this method is considered the expected price target. While such pattern targets are not always guaranteed, they provide an important reference point in line with the probability-based approach provided by technical analysis. They are also very meaningful in terms of investor psychology. The pennant patterns indicate that traders are in a period of indecision and digestion after the previous aggressive bullish move. However, this is usually temporary, and the price will resume its upward movement once confidence returns to the market. Therefore, traders should be cautious and alert to these patterns. This is because an upside breakout of the pattern can lead to sharp rises in an instant, and missing such moves can be detrimental in terms of opportunity cost. In conclusion, this pennant pattern, which is clearly visible on the chart, shows that the price has entered a short-term pause phase after a strong upward move in the past. The price appears to be testing the upper band within this compressed structure, and if this band is breached to the upside, technically this could be a harbinger of a new bullish wave. But we can't decide the analysis with just the pennant. Let's look at the other metrics. Stay tuned. Closer inspection of the chart reveals a critical horizontal resistance zone just above the current price level. This zone stands out as an area that the price has touched several times in the past, but failed to break through to the upside each time. Such resistance levels are considered highly significant in technical analysis because strong selling pressure builds up at these levels, both psychologically and structurally. As market participants approach these levels, they start to take profit realizations or hesitate to open new positions. Therefore, each contact with this zone has limited the upward movement of the price and caused it to react downwards. But at the same time, repeated tests of this level may also indicate that the seller's strength in this area is weakening. Such repeated tests are called resistance fatigue in technical analysis. The more the price touches a resistance level, the more sellers at that level may eventually exhaust their positions and be replaced by buyers. This causes the resistance level to become more susceptible to being broken over time. In other words, each new test is more likely to break than the previous one. In this context, the current chart structure suggests a process that is ripe for a breakout move. Also, the fact that this resistance level has been tested many times in the past makes it not just an ordinary resistance, but also a major resistance point. Breaking major resistance levels often leads to serious price explosions in technical analysis. This is because if these levels are breached, there is no longer a major barrier to the price, and the upward movement can accelerate as new buyers enter the market, especially if there is a significant increase in trading volume during the resistance breakout. It is a strong technical confirmation that the breakout is permanent. The breakout of such resistance zones can also be a trigger for pattern-based rallies. For example, if the price breaks through this resistance zone, it could be the completion of a previously formed triangle, pennant, double bottom, or shoulder-to-shoulder pattern. These are very clear and strong buy signals for technical traders. This is because pattern targets are usually triggered by the break of resistance levels, and these targets often imply medium or long-term bullishness, not short-term bullishness. In this context, it is also important to pay attention to the psychological dynamics behind the resistance level. This is usually the area where investors sell, thinking it won't go any higher from here. However, when the price breaks this zone, investors who were waiting or hesitating until then start to change their positions. This creates a sudden change of sentiment in the market. Sellers retreat while new buyers surge. This sudden shift in the supply-demand balance can push the price up quickly. Another thing to watch out for in case of a resistance breakout is the price behavior after the breakout. After a solid breakout, the price usually makes a short-term retracement and retests the resistance level it broke. This process is called a retest, and if this test is successful, the price is expected to start a new bullish wave. During the retest, it is important for traders to be careful and watch for positive candlestick patterns that may form in this area. This is because these points may offer the most efficient entry opportunities in terms of risk-reward ratio. Moreover, breaking such resistance levels is critical not only for short-term traders, but also for those with medium and long-term strategies. This is because it can be a strong signal of an upward trend reversal over a wider time frame. Breaking the resistance zones, especially on the weekly charts, can be a harbinger of a monthly uptrend. Often used in technical analysis, RSI plays a critical role in determining whether the market is in overbought or oversold territory, allowing traders to more closely assess market momentum. This indicator fluctuates between 0 and 100, and certain threshold levels in particular are areas that traders keep a close eye on. This is an important warning signal for traders, because when the RSI approaches this upper level, it may indicate that the bullish momentum is starting to weaken and the market is preparing to enter a correction or pullback. This behavior of the RSI sheds light not only on past price movements, but also on the points where investor psychology intensifies and buying power starts to run out. In particular, the fact that the RSI turns down from the same area every time indicates that this level has become an area of dynamic resistance. Such dynamic resistance zones are not limited to the specific numerical threshold of the RSI. In some cases, the RSI may also start to react in the 66, 68 range, and this level can be considered as an asset-specific resistance band. Therefore, the behavior patterns of the RSI should always be evaluated together with the past movements of the relevant instrument. When the RSI turns down after reaching these levels, this turn is often reflected in price movements. RSI indicator should be followed. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.